So in addition to the potential rate hikes, the Fed continues to allow the balance sheet to roll off. And this, I guess, listen, it might feel normal right now where we are. But even with this recent letting some of these assets roll off, look at that balance sheet. It's up 1,000% since 2002. This is added to the decline in global liquidity, the recent roll-off. And that, by the way, is one of the things that has my next guest worried. I want to bring in Real Talk Capital CEO Rob Luna. It's amazing. I remember, Rob, when we were saying on the street, or the saying was, hey, if the Fed's balance sheet gets to $1 trillion, that's it. Katie barred the door. It's all she wrote. You know, I hope we're not sitting here 10 years from now saying, if that balance sheet gets to $100 trillion, it's all she wrote. But now that they're letting it roll off a little bit, you're concerned? Or
Yeah,
is it
Charles,
too high?
I mean, I'm concerned. Yeah, I mean, look, I mean, the idea is the real people out there, the small business owners are feeling the crunch. I work with a lot of entrepreneurs, Charles, and it's day after day now, just over the last month and a half, that credit is tightening. They can't get loans. Some of their credit lines are getting cut. Credit cards are getting cut. And I think that's because the banks are worried. They're worried about the liquidity. They're worried about the commercial real estate crunch. We see what's happening with credit card debt up to $1 trillion for the first time ever. The consumer, in my view, is not as healthy as most people believe they are. And if this continues to worsen, I think we're going to start to see layoffs, and I think it's going to start to hit the real economy.
Yeah, credit cards over $1 trillion, the average interest rate 21%. Macy's, the Macy's card is 32% interest.
Wow.
Auto loans up 1.58 trillion, and those delinquencies are soaring, and soon student loan debt's going to soar, that delinquency. So I'm with you there. But we heard from Jay Powell earlier today, and this seems, I mean, part of his mission is this credit crunch you're talking about. It's unfortunately unnecessary. It's a necessary part, apparently, of the Fed's job to reel in inflation, which, by the way, he didn't create. He helped to create it. But this last part of it, the fiscal part, was out of his control. So these folks you're talking to, Rob, it's like they're between a rock and a hard place.
Yeah, it's really it. And so that's, I mean, really what has me worried. We're seeing everybody pull back. They're starting to brace. You know, the tough thing, I think, for investors, like you know, Charles, is the stock market is not the economy. The stock market's been rallying. And the idea, there's the major trend that's always worked since I've been in this market is to not fight the Fed. And what people are trying to do right now is jockey for position to see, okay, when is it over? They're looking at every word Powell's saying and the rest of the Fed. When are they going to start to cut rates? Because when that happens, the economy, the real economy, might be in the worst shape we've seen in the last 5 or 6 years. But what'll be the thing that disconnects is the stock market will actually start to rally. And that's why I think even a day like today, people don't want to be left on the sidelines.
Yeah, and by the way, it's the fight of 2023 has been don't fight the Fed or don't fight the tape. Don't fight the tape is one, to your point. We've got less than a minute. You like CrowdStrike. You've mentioned that before. Palo Alto Networks. Farfetch is a name you had talked about a few years ago. I didn't know you were still involved in it. It's getting hammered here recently. I mean, the last time I saw it was getting hammered. You still like the stock?
Yeah, I mean, Farfetch, look, and the thing is your time frame, right? CrowdStrike, Palo Alto, I buy those on every 10% dip. I'm not looking to sell those for 10 years. Those are going to be big winners, I believe. Farfetch is one. You got to trade around that a little bit. So I've been in and out of that stock. It just recently got absolutely demolished. But when you look at this company, Charles, the luxury space, it's a bull market stock. It's going to be highly dependent on China. That's not good right now, but you have to look out a year, year and a half, 2 years. You want to buy those best-in-breed companies when nobody wants them. Wade into those right now. Farfetch, I think if you buy it right now, put it away for a couple of years, you're going to make a lot of money on that stock.
So the high, the 52-week high was almost $13. The low is 250. Is at 290, 298 now. Do you use a stop loss on it?
I wouldn't, Charles. I mean, the thing is, at these levels, I mean, you look at Richemont, one of the biggest luxury companies out there. They were putting their own money in this stock at much higher valuations. Right. I think the stop loss, the risk management is position size. Don't put in a position size more than you're willing to lose, and I think you'll be okay.
All right. Hey, Rob, great stuff, man. Thank you so much. Talk to you again real soon.
Yeah, thanks, Charles.